next week, next month, next year. I know America's going to move forward over time, but I don't know for sure. And we learned this on September 10th, 2001, and we learned it a few months ago in terms of the virus. Anything can happen in terms of markets. And if you can bet on America, but you have to be careful about how you bet, because simply because markets can do anything. On October, whatever it was, in 1987, October 11th, I believe, Monday, markets went down 22% in one day. In 1914, they closed the stock market for about 4 months. After 9/11, closed the market for 4 days. We hustled to get it going again. But nobody knows what's going to happen tomorrow. So when you bet, I tell you to bet on America. And I tell you that's what's really gotten me through ever since I bought my first stock when I was 11. I mean, I caught a huge tailwind in America, but it wasn't going to blow in my direction every single day, and you don't know what's going to happen tomorrow. And I would like to, in the context of the present news, point out something you may find kind of interesting. If you go to YouTube, you'll find on June 17th of 2015, 4+ years ago, you'll find Sam Nunn, who's one of the people I admire the most in the United States, in the world, enormous patriot, tremendous senator, and he's carried on thankless work since leaving the Senate, and I'd say heading something called the Nuclear Threat Initiative, which most of you haven't heard of, but I've been slightly involved in it. Sam Nunn founded that. And the Nuclear Threat Initiative is simply organizations devoted to trying to reduce the chances of something of a nuclear, chemical, biological, and now cyber nature, from either malevolent or accidental or whatever it may be, from causing deaths to millions of Americans. And among the things, Sam co-founded it, but he's been the heart and soul of the organization subsequently. And they talked about, worried about pandemics along with the nuclear threat for decades. And he's participated in war games where they play out various scenarios, including malevolent pandemics that could be started by the same kind of nut that sent the anthrax letters in around 9/11, a little after. And Sam appeared on this YouTube presentation, and I'm sure he's been on many others. I just happened to look this one up, and talked about the dangers of a pandemic. And anybody should listen to Sam Nunn anytime he talks. So he said at that time, germs don't have borders, which we've certainly learned in the last couple of months. And when I clicked on YouTube, if you'll go to the next, I found out that it had 831 views, and this was only a few days ago. I looked it up, and maybe, I don't know whether most of those views have just been the last few days, or the last few months, I should say, because of the interest in pandemics. But it is hard to think about things that haven't happened yet. And so we can experience, when something like the current pandemic happens, it's hard to factor that in, and that's why you never want to use borrowed money, and at least in my view, in margin to buy into investments. And we run Berkshire that way. We run it so that we literally try to think of the worst case of not only just one thing going wrong, but other things going wrong at the same time, maybe partly caused by the first, but maybe independent even of the first. And, you learned in I don't know what grade now, probably earlier than when I went to school, but in 5th or 6th grade, that anything, you can have any series of numbers times 0 and just need 1 0 in there, and the answer is 0. And there's no reason to use borrowed money to participate in the American tailwind, but there's every other reason to participate. Now, I can't resist pointing out that in October of 2019, a large 300-page, got it right here, book was brought out, and Johns Hopkins, one of the most respected institutions in the country, the Nuclear Threat Initiative, NTI, and the intelligence group at The Economist collaborated to evaluate the problems of the worldwide preparedness for pandemics, essentially. And I think in November, Sam came out to see me with Ernie Maurice, former Secretary of Energy, who now is the CEO of NTI. He and Sam are co-chairman. And Beth Cameron, who did a lot of work on this report, came out to see me. And they gave me, in November, I believe, of last year, they gave me this appraisal. And the opening line, if you'll turn the page, this is the opening line of this 300-page tome. Biological threats, natural, intentional, or accidental, in any country can pose risk to global health, international security, and the worldwide economy. And this book was prepared in order to evaluate the preparedness of the various countries and rank them. We ranked pretty well, but all of the countries got a failing grade, basically. Now, you would think with the prestige of Johns Hopkins and The Economist, along with people like Sam and Ernie, et cetera, that this would have gotten some attention. And again, Sam, if you turn to the next page, Sam and the others went on YouTube on October 24th, 2019, and they have racked up, as of a couple days ago, 1,498 views. Now, my friend Bill Gates was delivering the same warning at a TED Talk some years back, and he's gotten a lot more views, but it just says something about the fact that you're going to get bolts from the blue, and you can read papers about them, and you can talk about what'll happen if some, as they used, the fellows at Sigma, Solomon used to tell me, some 25 Sigma event comes along, and they say that'll happen once in the life of the universe, and then it happens to them a couple of times in a month, and they go broke. You just don't know what's going to happen. At least in my view, that America's tailwind is not exhausted. You're going to get a fine result if you own equities over a long period of time. And the idea that equities will not produce better results than the 30-year Treasury bond, which yields 1.25% now. It's taxable, the income. it's the aim of the Federal Reserve to have 2% a year inflation. Equities are going to outperform that bond. They're going to outperform Treasury bills. They're going to outperform that money you've stuck under your mattress. I mean, they are a enormously sound investment as long as they're an investment and they're not a gambling device or something that you think you can safely, buy on margin or whatever it may be. It's interesting that stocks offer, stocks are we always look at stocks as just being a part of a business. I mean, stocks are a small part of a business. If in 1789 you'd saved a small amount of money and it wasn't easy to save, you might have bought, with those savings, you might have bought a tiny, tiny plot of property. Maybe you bought a house that could be rented to somebody, but you didn't really have the chance to buy in with 10 different people who were developing businesses and who were presumably putting their own money in, and that would have the American tailwind behind. And of the 10, a reasonably high percentage would succeed in a way and earn decent returns. But those are the choices you might have had to do with savings. And they started offering bonds originally, and there again you got a limited return, but the return may have been, in those days, may have been 5 or 6% or something of the sort. But you can't buy risk-free bonds. I mean, the yardstick for me is always the U.S. Treasury, and when somebody offers you quite a bit more than the U.S. Treasury, there's usually a reason. There's more risk. But going back to stocks, people bring the attitude to them too often that because they are liquid and quoted minute by minute, that it's important that you develop an opinion on them minute by minute. Now, that's really foolish when you think about it. And that's something Graham taught me in 1949. I mean, that single thought. Stocks were parts of businesses and not just little things that moved around on charts. Charts were very popular in those days, and whatever it may be. Imagine for a moment that you decided to invest money now, and you bought a farm. And the farmland around here, let's say you bought 160 acres, and you bought it at X per share, or per acre. And the farmer next to you had 160 identical acres, same contour, same quality of soil quality. So it was identical. And that farmer next door to you was a very peculiar character, because every day that farmer with the identical farm said, "I'll sell you my farm, or I'll buy your farm at a certain price," which he would name. Now, that's a very obliging neighbor. I mean, that's got to be a plus to have a fellow like that with the next farm. You don't get that with farms. You get it with stocks. If you own 100 shares of General Motors, on Monday morning, somebody will buy your 100 shares or sell you another 100 shares at exactly the same price, and that goes on 5 days a week. But just imagine if you had a farmer doing that. When you bought the farm, you looked to what the farm would produce. That was what went through your mind. You were saying to yourself, "I'm paying X dollars per acre. I think I'll get so many bushels of corn or soybeans on average. Some years good, some years bad. Some years the price will be good, some years the price will be bad, etc." But you think about the potential of the farm. And now you get this idiot that buys the farm next to you, And on top of that, he's sort of a manic depressive and drinks, maybe smokes a little pot. So his numbers just go all over the place. Now, the only thing you have to do is to remember that this guy next door is there to serve you and not to instruct you. You bought the farm because you thought the farm was had the potential. You don't really need a quote on it. If you bought in with John D. Rockefeller or Andrew Carnegie, and there were never any quotes. Well, there were quotes later on, but basically, you bought into the business, and that's what you're doing when you buy stocks. But you get this added advantage that you do have this neighbor who you're not obliged to listen to at all, who is going to give you a price every day, and he's going to have his ups and downs, and maybe he'll name a silly price that they'll buy at, in which case you sell if you want to, or maybe he'll name a very low price and you'll buy his farm from him. But you don't have to, and you don't want to put yourself in a position to where you have to. So stocks have this enormous inherent advantage of people yelling out prices all the time to you, and many people turn that into a disadvantage. And of course, many people can profit in one way or another from telling you that they can tell you what this farmer's going to yell out tomorrow or next, your neighboring farmer's going to yell out tomorrow or next week or next month. There's huge money in it. So people tell you that it's important and they know, and that you should pay a lot of attention to their thoughts about what price changes should be, or you tell yourself that there should be this great difference. But the truth is, if you owned the businesses you liked prior to the virus arriving, it changes prices and it changes, but nobody's forcing you to sell. And if you really like the business and you like the management you're in with, and the business hasn't fundamentally changed, and I'll get to that a little when I report on Berkshire, which I will soon, I promise, the stocks have an enormous advantage, and you still can bet on America, but you can't bet unless you're willing and have an outlook to independently decide that you want to own a cross-section of America, because I don't think most people are in a position to pick single stocks. A few maybe, but on balance, I think people are much better off buying a cross-section of America and just forgetting about it. If I'd done that when I got out of college, it's all I had to do to make 100 for one, and then collect dividends on top of it, which would increase substantially over time. The American tailwind is marvelous. American business represents, and it's going to have interruptions, and you're not going to foresee the interruptions, and you do not want to get yourself in a position where those interruptions can affect you, either because you're leveraged or because you're psychologically unable to handle looking at a bunch of numbers. If you really had a farm and you had this neighbor, and one day he offered you $2,000 an acre, and the next day he offers you $1,200 an acre, and maybe the day after that he offers you $800 an acre, are you really going to feel that at $2,000 an acre, when you had evaluated what the farm would produce, are you going to let this guy drive you into thinking I better sell because his number keeps coming in lower all the time? It's a very, very, very important matter to bring the right psychological approach to owning common stocks. But I will tell you, if you bet on America and sustain that position for decades, you're going to do better than, in my view, far better than owning Treasury securities, or far better than following people who tell you that what the farmer's going to yell out next. There's huge amounts of money that people pay for advice they really don't need, and for advice where the person giving it can be very well meaning in it and believe their own line, but the truth is that you can't deliver superior results to everybody by just having them trade around a business. If you bought into a business, it's going to deliver what the business produces, and the idea that you can outsmart the person next to you, or that the person advising you can outsmart the person sitting next to you is well, it's really the wrong approach. So find businesses, get a cross section. In my view, for most people, the best thing to do is to own the S&P 500 index fund. People will try and sell you other things because there's more money in it for them if they do. And I'm not saying that that's a conscious act on their part. Most good salespeople believe their own baloney. I mean, that's part of being a good salesperson, and I'm sure I've done plenty of that in my life too. But it's very human. If you keep repeating something often enough, that's why lawyers have the witnesses keep saying things over and over again. That by the time they get on the witness stand, they'll believe it, whether it was true in the first place or not. But you are dealing with something fundamentally advantageous, in my view, in owning common stocks. I will bet on America the rest of my life, and I hope my successors at Berkshire do it. Now, we do it in two different ways. We do it by buying entire businesses, and we buy parts of businesses. And I would like to emphasize that, well, I'd like to give you a few figures that will tie in from our activities in the first quarter and also what we've done in April. We are not right about, we do try to pick businesses that we think we understand. We don't buy the S&P 500, and we like to buy the entire businesses when we buy them, but we don't get a chance to do that very often. Most of the best businesses are not available for sale in their entirety, but we don't mind in the least buying partial interests in businesses, and we would rather own 6 or 7 or 8%, of a wonderful company and regard it as a partnership interest, essentially, in that company, and that we get an opportunity to do that through marketable securities, and sometimes we get more opportunities than others. And with that, I hope I've convinced you to bet on America. I'm not saying that this is the right time to buy stocks. If you mean by right that they're going to go up instead of down, I don't know where they're going to go in the next day or week or month or year. But I hope I know enough to know, well, I think I can buy a cross-section and do fine over 20 or 30 years. And you may think that's kind of, for a guy 89, that's taking kind of an optimistic viewpoint. But I hope that really everybody would buy stocks with the idea that they're buying partnerships in businesses, and they wouldn't look at them as chips to move around up or down. So we will just now take a quick look. And I see we've got Becky's email address. So if you have questions on what I've said or other things, you can email these questions, and she is back there, probably sort of a madhouse trying to handle questions coming in and pick out the ones she's going to prioritize. But feel free to, anything I've talked about so far, to send along to her, and we'll keep her address up when I later hold the formal part of the meeting too. Very briefly, in terms of Berkshire, in the first quarter, if you'll put up, do we have the slides on that? There we are. Our operating earnings were, and there's much more about this in the 10Q, and it's really not worth spending any real time on, but the operating earnings for the first quarter have no meaning whatsoever in terms of forecasting what's going to happen the next year. And I don't know the consequences of shutting down the American economy. I know eventually it will work, whatever we do. We may make mistakes. We will make mistakes, and I'm not, during this talk and later on, I'm not going to be second-guessing people on this because nobody knows for sure what any alternative action would produce or anything of the sort. But what we do know is that for some period, certainly during the balance of the year, but it could go on a considerable period of time, who knows. But our operating earnings will be less, considerably less, than if the virus hadn't come along. I mean, it hurts some of our businesses a lot. I mean, you shut down. Some of our businesses effectively been shut down. It affects others much less. Our three major businesses of insurance and the BNSF Railroad, and our energy business, those are our three largest by some margin. They're in a reasonably decent position. They'll spend more than their depreciation. So some of the earnings will go, along with depreciation, will go toward increasing fixed assets. But basically, these businesses will produce cash even though their earnings decline somewhat. And if we'll go to part two, at Berkshire, we keep ourselves in an extraordinarily strong position. We'll always do that. That's fundamental. We insure people. We're a specialist to some extent and a leader. It's not our main business, but we sell structured settlements. That means somebody gets in a terrible accident, usually an auto accident, and they're going to require care for 10, 30, 50 years. And their family or their lawyer is wise enough, in our view, to, rather than take some big cash settlement, to essentially arrange to have money paid over the lifetime of the individual to take care of their medical bills or whatever it may be. And we're large. We've got many, many, many people that, in effect, have staked their well-being on the promises of Berkshire to take care of them for, like I say, maybe 50 years or longer into the future. And, now, I would never take real chances with money of other people's money under any circumstances. Both Charlie and I come from a background where we ran partnerships. I started mine in 1956 for really 7, either actual family members or the equivalent. And Charlie did the same thing 6 years later. And we neither one of us, I think, I know I didn't, and I'm virtually certain the same is true of Charlie, neither one of us ever had a single institution investment with us. I mean, every single bit of money we managed for other people was from individuals, people with faces attached to them, or entities, or money with faces attached to them. And so we've always felt that our job is basically that of a trustee, and hopefully a reasonably smart trustee in terms of what we were trying to accomplish. But the trustee aspect has been very important. It's true for the people with the structured settlements. It's true for up and down the line, but it's true for the owners very much too. So we always operate from a position of strength. Now, I show on a slide that's up, I show our, let's go back one. I show our net, our cash and treasury bill position on March 31st. And you might look at that and say, well, you've got 125 billion or so in cash and treasury bills, and you've got, at least at that point, we had about 180 billion or so in equities, and you can say, well, that's a huge position to have in treasury bills versus just 180 billion in equities. But we really have far more than that in equities because we own a lot of businesses. We own 100% of the stock of a great many businesses, which to us are very similar to the marketable stocks we own. We just don't own them all. They don't have a quote on them. But we have hundreds of billions of wholly owned businesses. So they are 124 billion is not some 40% or so cash positions. It's far less than that, and we will always keep plenty of cash on hand, and for any circumstances. If a 9/11 comes along, if the stock market is closed as it was in World War I, it's not going to be. But I didn't think we were going to be having a pandemic when I watched that Creighton Villanova game in January either. So we want to be in a position at Berkshire where, well, you remember Blanche DuBois and A Streetcar Named Desire. That goes back before many of you, but she said she didn't want to. In Blanche's case, she said that she depended on the kindness of strangers, and we don't want to be dependent on the kindness of friends even, because there are times when money almost stops. And we had one of those, interestingly enough. We had it, of course, in 2008 and 9, but right around the day or two.
I'm moving my stop on profit for euro, as you can see, and as you can check our positions. We have position at 118.62. I moved stop on profit for that position to 118.67. All right, so it's moved only for one position. Stop on profit for 118.67.
Finance themselves to some extent through commercial paper because that was very cheap and it was backed up by bank lines and all of that, and they let the debt creep up quite a bit of many companies, and then of course they had the hell scared out of them by what was happening in markets, particularly the equity markets, and so they rushed to draw down lines of credit, and that surprised the people who had extended those lines of credit. They got very nervous, and the capacity of Wall Street to absorb a rush to liquidity that was taking place in mid-March was strained to the limit, to the point where the Federal Reserve, observing these markets, decided they had to move in a very big way. We got to the point where the U.S. Treasury market, the deepest of all markets, got somewhat disorganized. And when that happens, believe me, every bank and CFO in the country knows it, and they react with fear, and fear is the most contagious disease you can imagine. It makes the virus look like a piker. And we came very close to having a total freeze of credit to the largest companies in the world who were depending on it. And to the great credit of Jay Powell, I've always had Paul Volcker up on a special place, special pedestal in terms of Federal Reserve chairman. Over the years, we've had a lot of very good Fed chairman, but Paul Volcker, I had him at the top of the list, and I'll recommend another book. Paul Volcker died about maybe a year ago or a little less. But not much before he died, he wrote a book called Keeping at It. And If you call my friends with the bookworm, I think you'll enjoy reading that book. Paul Volcker was a giant. In many ways, he was a big guy, too. He and Jay Powell couldn't see more in temperament or anything. But Jay Powell, in my view, and the Fed board belong up there on that pedestal with him because they acted in the middle of March, probably somewhat instructed by what they'd seen in 2008 and 9. They reacted in a huge way and essentially allowed what's happened since that time to play out the way it has. March, where the market had essentially frozen close a little after mid-month, ended up, because the Fed took these actions on March 23rd, it ended up being the largest month for corporate debt issuance, I believe, in history. And then April followed through and was even a larger month. And you saw all kinds of companies grabbing everything, coming to market, and spreads actually narrowed. And every one of those people that issued bonds in late March and April sent a thank you letter to the Fed, because it would not have happened if they hadn't operated with really unprecedented speed and determination. And we'll know the consequences of swelling the Fed's balance sheet. You can look at the Fed's balance sheet. They put it out every Thursday. It's kind of interesting reading if you're sort of a nut like me. But it's up there on the internet every Thursday, and you'll see some extraordinary changes there in the last 6 or 7 weeks. And like I say, we don't know the consequences of that, and nobody does exactly. And we don't know the consequences of what they undoubtedly will have to do, but we do know the consequences of doing nothing. And that's would have been the tendency of the Fed in many years past, not doing nothing, but doing something inadequate. But Mario Draghi, brought the whatever it takes to Europe, and the Fed in mid-March sort of did whatever it takes squared, and we owe them a huge thank you. But we're prepared at Berkshire. We always prepare on the basis that maybe the Fed will not have a chairman that acts like that, and we really want to be prepared for anything. So that explains some of the $124 billion in cash and bills. We don't need it all, but we do never want to be dependent on not only the kindness of strangers, but the kindness of friends. Now, in the next slide, we have what we did in equities, and these numbers are tiny when you get right down to it. I mean, for having 500 billion or so in net worth, and I mean not in net worth, but in market value at the start of the year, or something close to that. We bought in 1.7 billion of stock, and our purchases were a couple of billion more than our sales of equities. But as you saw in the previous slide, we had operating earnings of almost 6 billion, and so we did very, very little in the first quarter. And then I've added another figure which I wouldn't normally present to you, but I want to be sure that if I'm talking to you about investments in stocks more than I usually have, I want you to know what Berkshire's actually doing now. You'll see in the month of April that we net sold 6 billion or so of securities, and that isn't because we thought the stock market was going to go down or anything of the sort, or because somebody changes their target price or they change this year's earnings forecast. I just decided that I'd made a mistake in evaluating as an understandable mistake. It was a probability-weighted decision when we bought that we were getting an attractive amount for our money when investing across the airlines business. So we bought roughly 10% of the 4 largest airlines, and we probably, this is not 100% of what we did in April, but we probably paid $7 or $8 billion, somewhere between $7 and $8 billion, to own 10% of the 4 large companies in the airline business, and we felt for that we were getting $1 billion roughly of earnings. Now we weren't getting $1 billion of dividends, but we felt our share of the underlying earnings was $1 billion, and we felt that number was more likely to go up than down over a period of time. That it would be cyclical, obviously, but it was as if we bought the whole company, but we bought it through the New York Stock Exchange, and we could only effectively buy 10% roughly of the 4, and we treated mentally exactly as if we were buying a business, and it turned out I was wrong about that business because of something that was not in any way the fault of 4 excellent CEOs. I mean, believe me, no joy being a CEO of an airline, but the companies we bought were well managed. They did a lot of things right. It's a very, very, very difficult business because you're dealing with millions of people every day, and if something goes wrong for 1% of them, they're very unhappy. So I don't envy anybody the job of being CEO of an airline, but I particularly don't enjoy them being in a period like this where essentially nobody, and people have been told basically not to fly. I've been told not to fly for a while. I'm looking forward to flying. May not fly commercial, but that's another question. But the airline business, and I may be wrong, and I hope I'm wrong, but I think it changed in a very major way, and it's obviously changed in the fact that the 4 companies are each going to borrow, perhaps an average of at least 10 or 12 billion each. Well, you have to pay that back out of earnings over some period of time. I mean, you're 10 or 12 billion dollars worse off if that happens, and of course, in some cases, they're having to sell stock or sell the right to buy a stock at these prices, and that takes away from the upside down. And I don't know whether 2 or 3 years from now that as many people will fly as many passenger miles as they did last year. They may and they may not. But the future is much less clear to me about how the business will turn out through absolutely no fault of the airlines themselves. But something that was a low probability event happened, and it happened to hurt particularly, whether it's the travel business, the hotel business, the cruise business, the theme park business, but the airline business in particular. And of course, the airline business has the problem that if the business comes back 70% or 80%, the aircraft don't disappear. So you've got too many planes, and it didn't look that way when the orders were placed a few months ago, or when arrangements were made. But the world changed for airlines, and I wish them well. But it's one of the businesses we have. We have businesses we own directly that are going to be hurt significantly. The virus will cost Berkshire money. It doesn't cost money because our stock and various other businesses moves around. I mean, if XYZ, which is, say, is one of our holdings, and we own it as a business and we like the business, the stock goes down 20 or 30 or 40%. We don't feel we're poor in that situation. We felt we were poor in terms of what actually happened to those airline businesses, just as if we'd owned 100% of them. So that explains those sales, which are relatively minor, but I want to make sure that nobody thinks that involves a market prediction. And that pretty well wraps it up for Berkshire. So now we move into the formal part of the meeting, which will be followed by a fairly extended question and answer period if there are a lot of questions with Becky. And while we're doing this formal part of the meeting, it's not too exciting, so feel free to...
As you can see, position closed on Japanese yen at 105.976.
Contact information up on the screen, or if you want to pick yourself a sandwich or do anything else, we will now move, or you can pay attention to the formal part of the meeting. But we will do this, and won't take too long, and then we will move on to the question and answer meeting. So with that, I will call the meeting to order, and this follows the script, as if you can't tell by what I'm saying. I'm Warren Buffett, Chairman of the Board of Directors of the company, and I welcome you to this 2020 Annual Meeting of Shareholders. Mark Hamburg is Secretary of Berkshire Hathaway, and he will make a written record of the proceedings. Dan Jackson has been appointed Inspector of Elections at this meeting. He will certify to the count of votes cast in the election for directors and the motions to be voted upon at this meeting. The named proxy holders for this meeting are Walter Scott and Mark Hamburg. Does the Secretary have a report of the number of Berkshire shares outstanding entitled to vote and represented at the meeting?
Yes, I do. As indicated in the proxy statement that accompanied this the notice of this meeting that was sent to all shareholders of record on March 4th, 2020, the record date for this meeting, there were 699,123 shares of Class A Berkshire Hathaway common stock outstanding, with each share entitled to one vote on motions considered at the meeting, and 1,382,352,370 shares of Class B Berkshire Hathaway common stock outstanding, with each share entitled to 1/10,000th of one vote on motions considered at the meeting. Of that number, 472,037 Class A shares and 834,802,274 Class B shares are represented at this meeting by proxies returned through Thursday evening, April 30th.
Thank you. That number represents a quorum, and we will therefore directly proceed with the meeting. First order of business will be a reading of the minutes of the last meeting of shareholders. I recognize Ms. Debbie Bozanik, who will place a motion before the meeting.
I move that the reading of the minutes of the last meeting of shareholders be dispensed with and the minutes be approved.
Do I hear a second?
I second the motion.
The motion is carried. The next item of business is to elect directors. I recognize Ms. Debbie Bozanik to place a motion before the meeting with respect to election of directors.
I move that Warren Buffett, Charles Munger, Gregory Abel, Howard Buffett, Stephen Burke, Kenneth Chenault, Susan Decker, David Gottesman, Charlotte Guyman, Ajit Jain, Thomas Murphy, Ronald Olson, Walter Scott, and Merrill Whitmer be elected as directors.
I second the motion.
It has been moved and seconded that Warren Buffett, Charles Munger, Greg Abel, Howard Buffett, Steve Burke, Ken Chenault, Susan Decker, David Gottesman, Charlotte Guyman, Ajit Jain, Tom Murphy, Ron Olson, Walter Scott, and Merrill Whitmer be elected as directors. The nominations are ready to be acted upon. Mr. Jackson, when you're ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening cast not less than 543,203 votes for each nominee. That number exceeds a majority of the number of the total votes of all Class A and Class B shares outstanding. The certification required by Delaware law of the precise count of the votes will be given to the secretary to be placed with the minutes of this meeting.
Thank you, Mr. Jaski. Warren Buffett, Charles Munger, Greg Abel, Howard Buffett, Steve Burke, Ken Chenault, Susan Decker, David Gottesman, Charlotte Guyman, Jeet Jane, Tom Murphy, Ron Olson, Walter Scott, and Merle Whitmer have been elected as directors. And Ken, if you're watching or listening, Ken Chenault, our new director, actually got the highest vote of all the directors, well ahead of me, I might add. So congratulations, Ken. The next item on the agenda is an advisory vote on the compensation of Berkshire Hathaway's executive officers. I recognize Ms. Debbie Bosanic to place a motion before the meeting on this item.
I move that the shareholders of the company approve on an advisory basis the compensation paid to the company's named executive officers as disclosed pursuant to item 402 of Regulation SK, including the compensation discussion and analysis, the accompanying compensation tables, and the related narrative discussion in the company's 2020 annual meeting proxy statement.
I second the motion.
It has been moved and seconded that the shareholders of the company approve on an advisory basis the compensation paid to the company's named executive officers. Mr. Jackson, when you are ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening cast not less than 519,750 votes to approve on an advisory basis the compensation to the company's named executive officers, the compensation paid to the company's named executive officers. That number exceeds a majority of the number of the total votes of all Class A and Class B shares outstanding. The certification required by Delaware law of the precise count of the votes will be given to the secretary to be placed with the minutes of this meeting.
Thank you, Mr. Jackson. The motion to approve on an advisory basis the compensation paid to the company's named executive officers has passed. The next item on the agenda is an advisory vote on the frequency of a shareholder advisory vote on compensation of Berkshire Hathaway's executive officers. I recognize Ms. Debbie Bosanic to place a motion before the meeting on this item.
I move that the shareholders of the company determine on an advisory basis the frequency, whether annual, biennial, or triennial, with which they shall have an advisory vote on the compensation paid to the company's named executive officers as set forth in the company's 2020 annual meeting proxy statement.
I second the motion.
It's been moved and seconded that the shareholders of the company determine the frequency with which they shall have an advisory vote on compensation of named executive officers, with the option being every 1, 2, or 3 years. Mr. Jackson, when you are ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening casts 131,443 votes for a frequency of every year, 2,228 votes for a frequency of every 2 years, and 419,984 votes for a frequency of every 3 years of an advisory vote on the compensation paid to the company's named executive officers. The certification required by Delaware law of the precise count of the votes will be given to the secretary to be placed with the minutes of this meeting.
Thank you, Mr. Jackson. The shareholders of the company have determined on an advisory basis that they shall have an advisory vote on the compensation paid to the company's named executive officers every 3 years. Now we're through with sort of the boilerplate resolutions, and this next item is of more importance, and we have put up on the BerkshireHathaway.com site some material relating to this motion, which I hope shareholders and others read, because it's important, and well, I'll describe it as the script says. The next item of business is a motion put forth by the boards of trustees of the New York City Employees Retirement System, the New York City Teachers Retirement System, the New York City Police Pension Fund, and the New York City Fire Pension Funds, collectively called the systems. The motion is set forth in the proxy statement. The motion requests that the company adopt a policy for improving board and top management diversity. The directors have recommended that the shareholders vote against the proposal. I'd like to interrupt the script here just a second to point out that we, when we saw that it would be impossible to have shareholders attend this meeting and traveling to Omaha and gatherings which really neither the governor, the mayor, or the public safety people thought would be advisable. We were hoping to have somebody from the controller's office come and present the motion and then have a good discussion at the meeting of the pros and cons, because it's a serious, important subject. And I can tell you on a personal basis, I think I'm in sync with the controller in terms of how he wants the world to evolve, but I disagree on the specifics of this motion as applied to board generally and to Berkshire's board in particular. And we've been very outspoken over the years. We've probably written more on qualifications for directors than probably any public company I can think of, and we've been consistent over the years, and we've explained the reasons for our position, and we know a great many people disagree with that position. So I welcome the idea of really presenting to our meeting and having our shareholders hear what they had to say and evaluate what our thoughts were. And when we had to essentially not allow shareholders at the meeting, we immediately got in touch with the controller's office, and we said we'd make an exception if anybody from the controller's office wanted to come out and present the proposition or the proposal and engage in a discussion of the pros and cons. And as you might expect, they were not in a position to send somebody, and we offered, we may have made it even in the first place, we'd be glad to have somebody introduce the motion on their behalf.
I'm moving my stop on profit to 118.69. This is stop on profit for euro to 118.69.
Person that was their proxy in effect present the motion. We'd be happy to have them read the supporting statement, and we said we'd appreciate it if they keep it to 5 minutes or less. And they wrote back immediately or emailed back immediately and said that they'd be delighted to do it that way, and they'd even try and keep it down to 3 minutes. So they have sent a supporting statement, which is going to be read to you in a minute, and I'm glad they did it. I do hope shareholders will, or have already, and others will listen to what the supporting statement says, and will also read the original arguments that they made in the proxy for their proposal, and they will read our reasons for voting against, to suggest voting against, because it's an important topic, and I really hope that next year that if somebody from the controller's office wishes to come out, we'd be glad to have even a more fulsome discussion of the subject. So with that, I will now recognize Mr. Hamburg to read a statement prepared by the controller of the City of New York in support of the motion.
Thank you. Mr. Chairman, members of the board, fellow share owners. I'm Mark Hamburg from Berkshire Hathaway, and I'm here to present Proposal 4 on behalf of the New York City Comptroller, Scott Stringer, and the New York City Pension Funds. The funds have approximately $211 billion in assets as of February and are substantial long-term Berkshire Hathaway share owners with 2.5 million shares. Our proposal requests that Berkshire Hathaway Board adopt a diversity search policy requiring that the initial candidates from which new director nominees and external CEOs are chosen include qualified female and racially or ethnically diverse candidates. First of all, we would like to commend the directors for the addition of Mr. Kenneth Chenault and the fact that 21% of the board is made up of women. We would also like to recognize that the executive pipeline includes diverse candidates, including Mr. Ajit Jain, another board member. Secondly, we applaud Mr. Buffett's recognition that women in the boardroom have historically been rare, and even more importantly, that although women won the right to have their voices heard in a voting booth a century ago, attaining similar status in a boardroom remains a work in progress. With our share owner proposal, what we are seeking is to nudge this particular process forward. Thirdly, one of the things that Mr. Buffett mentions is that he only buys businesses that have 3 criteria, the second of which is able and honest managers, and that the most important duty for a board is to find and retain a talented CEO. We would note that in reviewing Berkshire Hathaway's largest stock market holdings of businesses, all 10 of these companies have boards that meet our board diversity requirement. In essence, the companies that Berkshire Hathaway has found fit to invest in are those that have more diverse boards. Fourthly, we would like to clarify that through this shareholder proposal, we are not asking for the Berkshire Hathaway board, our guardians, to have a quantifiable end result in terms of its composition, but that an initial pool of candidates for a board seat include a woman and another individual who is racially or ethnically diverse. We believe these candidates, if qualified, would also have very high integrity, business savvy, shareholder orientation, and a genuine interest in the company. According to a 2016 Harvard Business Review study, including more than one woman or a member of a racial minority in a finalist pool helps combat the unconscious biases amongst interviewers and increases the likelihood of a diverse hire. What we are requesting is a small step in that direction to include diverse candidates at the beginning of the search. Finally, we would like to applaud Berkshire Hathaway's robust internal CEO succession plans. Our proposal states that a CEO diversity policy should only apply in the case of an external search. The New York City Comptroller's Office is disappointed that we never had the opportunity to discuss our proposal with directors or management, but remain open to constructive engagement. In the interim, we strongly urge Berkshire Hathaway share owners to support Proposal 4. Thank you.
Okay, thanks, Mark, and thank you to the controller for presenting that supporting statement. The motion is now ready to be acted upon. Mr. Jackson, when you are ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening cast 65,925 votes for the motion and 485,824 votes against the motion. As the number of votes against the motion exceeds a majority of the number of votes of all Class A and Class B shares properly cast on the matter, as well as all votes outstanding, the motion has failed. The certification required by Delaware law of the precise count of the votes will be given to the Secretary to be placed with the minutes of this meeting.
Thank you, Mr. Jackson. The proposal fails.
I move that this meeting be adjourned.
I second the motion to adjourn.
The motion has been made and seconded. The meeting is adjourned. So thank you. I'm just looked at my watch and I talked a lot longer than I should have probably. And that's not a unique experience of mine that just occurred. So now we're ready to have questions which Becky Quick has selected from those that's been forwarded to her directly and from from Carol Loomis and Andrew Ross Sorkin, and Greg and I are available to be, we'll be answering them for some time. So Becky, you're on, and I hope all the I hope everything works.
Yeah, Warren, I should tell you that since you put that address up on the screen, I've gotten more than 2,500 emails that have been coming in. So there is a lot of demand from shareholders wanting to get in and ask questions. And I'll ask some that we've compiled before and some that are coming in right now. The first question, though, comes from one that just came in based on the comments that you were actually saying. This is a question that comes from William Lewis. He said, please, did I understand correctly, Mr. Buffett, to say that Berkshire Hathaway sold its interests in 4 different airlines? And if so, can you name them? Can the names of those airlines be identified?
Yeah, I wouldn't normally talk about it, but I think it requires an explanation, and it requires an explanation that means we were not disappointed at all in the businesses that they were being run and the management, but we did come to a different opinion on it. And they're the 4 largest U.S. airlines. It's the American Airlines and Delta Airlines and Southwest Airlines and United Continental. And I think collectively they probably are at least 80% of the revenue passenger miles that is flown in the United States, and they have significant international flying too, excluding Southwest. So we like those airlines. But we don't. I like the world has changed for the airlines, and I don't know how it's changed, and I hope it corrects itself in a.
I closed position on Euro USD, United States dollar at 118.69.
That we're semi-shut down in the economy. I don't know whether the trends toward what people have been doing by phone. I mean, it's been 7 weeks since I've had a haircut. It's been 7 weeks since more than 7 weeks since I put on a tie or anything. I've been just a question of which sweatsuit I wear. So who knows how we come out of this? But I think that there's certain industries, and unfortunately, I think that the airline industry, among others, that are really hurt by a forced, in fact, shut down by events that are far beyond their control. Greg, would you like to add anything to that?
Really nothing to add, Warren.
Okay. Well, we got another Charlie here.
I didn't intend to use that as a line, but you've covered it well.
Yeah, we would have bought other airlines too, incidentally, but those were the 4 big ones, and those ones we could put some money into, and we put whatever it was, $7 or $8 billion into it, and we did not take out anything like $7 or $8 billion, and that was my mistake. But it's always a problem if there are things on the lower levels of probabilities that happen sometimes, and it happened to the airlines, and I'm the one who made the decision.
But Warren, just to clarify on his question, he asked, did you sell your whole stake in all 4 of those?
The answer is yes. Yeah, when we sell something, we sell something, very often it's going to be our entire stake. I mean, we don't trim positions or that. That's just not the way we approach it any more than if we buy 100% of a business, we're going to sell it down to 90% or 80%. I mean, if we like a business, we're going to buy as much of it as we can and keep it as long as we can. But when we change our mind,
Right, the next
go
question.
ahead. I'm sorry.
No, go ahead. When you change your mind?
Well, when we change our mind, we don't take half measures or anything of the sort. So I was amazed at how, frankly, now we were selling them at far lower prices than we paid, but I was amazed at the volume. The airlines always trade in large volume relatively, but we have sold the entire positions.
Okay, thank you. The next question comes from Robert Tomas from Toronto, Canada, and he says, Warren, why are you recommending listeners to buy now, yet you're not comfortable buying now, as evidenced by your huge cash position?
Well, as I explained, the position isn't that huge when I look at worst case possibilities. I would say that there are things that I think are quite improbable, and I hope they don't happen, but that doesn't mean they won't happen. I mean, for example, in our insurance business, we could have the world's or the country's #1 hurricane that it's ever had, but that doesn't preclude the fact we could have the biggest earthquake a month later. So we are not, we don't prepare ourselves for a single problem. We prepare ourselves for problems that sometimes create their own momentum. I mean, 2008 and 2009, you didn't see all the problems the first day when what really kicked it off was when the Freddie and Fannie, the GSEs, went into conservatorship in early September. And then when money market funds broke the buck, I mean, there are things that trip other things, and we take a very much a worst case scenario into mind that probably is a considerably worse case than most people do. So I don't look at it as huge, and I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more, and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred, but if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others. It's like the virus. It strikes some people with much greater ferocity than others, and fear is something I really never felt financially, but I don't think Charlie's felt it either. But some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks, because you're going to buy and sell them at the wrong time. And you should not count on somebody else telling you this. You should do something you understand yourself. If you don't understand it yourself, you're going to be affected by the next person you talk to. And so you should be in a position to hold. And I don't know whether today is a great day to buy stocks. I know it will work out over 20 or 30 years. I don't know whether it'll work out over 2 years at all. I have no idea whether you'll be ahead or behind on a stock you buy on Monday morning or the market.
Warren, the next question comes from Scott Kelly, and he writes in based on the numbers you just put up. He said, what did you spend the $426 million on equities in April? Was that adding to existing positions, or was that initiating new positions?
Well, I don't remember, to tell you the truth, but one thing you have to allow for, well, these are the figures for Berkshire Hathaway, and they include both Todd Combs and Ted Weschler manage significant sums of money. So it could well be something they bought. It could be something I bought. But $462 million is not much money at Berkshire. It's more to Todd and Ted than it is to me in terms of our positions. But I literally have no memory of. We're not doing anything big, obviously. We're willing to do something very big. I mean, you could come to me on Monday morning with something that involved 30 or 40 billion or $50 billion, and if we really liked what we were seeing, we would do it, and that will happen someday. If it happens in the market, we can't put it all in one day or 1 week or 1 month. It took us months to build up our airline position, many months. We were able to sell them faster than we bought them, but we were selling them at lower prices. The 462 is essentially meaningless, and it may not have even, it probably was not mine.
All right, this next question comes from Lee Yandar, and his question is, in the last financial crisis, Berkshire acted as a lender of support for 8 different deals. Despite the injection of expensive capital through preferred stocks and securing warrants, these companies were in fact paying for the sign of confidence from Berkshire in the midst of a crisis, and that was invaluable. Today we have QE infinity, low interest rates, and hungry hedge funds. Even though the economy has deteriorated rapidly over the last few months, why have we not acted as a lender of support yet?
Well, we haven't seen anything attractive. And frankly, it wasn't predicated on this, but the Federal Reserve did the right thing, and they did it very promptly, which they should have, and I salute them for it. But that means that a lot of companies that needed money and probably should have done their financing a little earlier, but they're perfectly decent companies, got the chance to finance in huge ways in the last 5 weeks or thereabouts. I mean, it's set records. Some companies have come back twice. A number of very big companies that didn't bother to extend out their borrowings came a couple times. Berkshire actually raised some more money. We don't need it, but I think it's still a good idea over time. And then there are some pretty marginal companies that have also had access to money. So there is no shortage of funds at rates which we would not invest at. We have not done anything because we don't see anything that attractive to do. Now that could change, very quickly, or it may not change. But in 2008 and 2009, the truth is, we weren't buying those things to make a statement to the world. They may have made a statement to the world to some extent, and I'm glad that they did if they did. But we made them because they seemed intelligent things to do, and markets were such that we didn't really have much competition. Now, it turned out that we would have been a lot better off if we'd waited 4 or 5 months to do similar things. So my timing was actually terrible in 2008 or 2009, but what was available was so attractive that even though my timing was terrible, we still came out okay, or a little bit better than okay. But it was not designed. What we did was not designed to make a statement. It was designed to take advantage of what we thought were very attractive terms, but they were terms that nobody else was willing to offer at that time because the market was in a state of panic. And the market in equities was in a state of panic for a short period of time when the virus broke out or spread to the United States, and it became apparent. And the debt market was frozen, or in the process of freezing, and that changed dramatically when the Fed acted, but who knows what happens next week or next month or next year. The Fed doesn't know. I don't know. And nobody knows. There's a lot of different scenarios that can play out, and under some scenarios we'll spend a lot of money, and other scenarios we won't. Greg, you've been watching what's been happening around Berkshire.
Yeah, well, I think your comment on the Fed, Warren, because as you know, interestingly, when it was first occurring, there were calls coming in, not the size of transactions we're interested in, nor companies we were inclined to act upon. But there was that general interest out there as people were in a difficult point in time, i.e. looking at their balance sheet and deciding what they were going to do. But the reality is those companies were not of interest. And post basically effectively March 23rd, the companies have been able to act. And Warren touched on it at Berkshire Hathaway Energy. Post the Fed action, we actually issued $4 billion of securities that was associated with some debts or obligations we had maturing, some short-term obligations we wanted to clearly lengthen out. And we pre-funded one of our capital programs at Pacific Corp with the thought this was the time to get the funds in place such that we could proceed with what is really an excellent opportunity both for Pacific Corp, our customers, and ultimately for the Berkshire shareholders. So we've taken action within Berkshire, as Warren noted.
This is a very good time to borrow money, which means it may not be such a great time to lend money, but it's good for the country that it's a good time to borrow money. Not good for Berkshire particularly, although we borrowed some money, so yeah. We've put our money where our mouth is.
That gets kind of to another question that came in from Mark McNicholas in Chicago, Illinois. He says Berkshire itself has a Fort Knox-like balance sheet, but some of its operating companies may be tight on cash during the pandemic. Would Berkshire consider sending cash to its operating companies to, one, ensure that they can get through the pandemic, and two, allow them to increase market share while their competitors struggle?
Well, we've sent money to a few, and we're in a position to do that. We're not going to send money indefinitely to anything where it looks like their future has changed dramatically from what it was a year or so ago, or even 6 months ago. You know, we made that decision in terms of the airline business. We took money out of the business, basically, even at a substantial loss. And we will not fund a company that where we think that it's going to chew up money in the future. We started out with a company like that in our textile business at Berkshire Hathaway in 1965, and we went for 20 years trying to think we could solve something that wasn't that solvable. So we are not in the business of subsidizing any companies with shareholders' money. If people want to do that with their own money, but we're not going to do it on their behalf. But we have advanced money. We're perfectly ready to advance money, gaining market share and all that. That may happen, but the companies that need money probably market share is not their number one problem. I'll put it that way. Greg, would you?
Yeah. Well, yeah, it's interesting when we look at our different companies as we went into the pandemic or we're addressing the COVID-19 crisis. Obviously, the first focus by our management team, and appropriately, was our employees and effectively making sure they're safe and that the business environment we're in, that they could continue to operate. Then we quickly moved to looking at where our customers were in the cycle, i.e. what was the underlying demand within the business. And to great credit to our managers, they very much have adjusted their businesses consistent with the underlying needs and demands of our customers. So effectively, they're moving with the customer, meaning very few of our businesses have actually required funds. Some have, and as Warren said, we've advanced the funds to them, but the businesses have really reacted in a way where they're managing consistent with where the market's at, i.e. the demand for their products.
Yeah, Berkshire is almost certain to generate cash. I mean, nothing's 100% certain, but we're, as Greg mentioned, at Berkshire Hathaway Energy, we had some short-term financing. We don't have short-term financing at any degree. We'll never get ourselves in a position where we have a lot of money that can come due tomorrow. And people that were financing heavily with commercial paper and then found their business stopped. Well, you've seen what's happened to the airlines. I mean, they need money. cruise lines need money. There's some businesses that, it's just the nature of what they're in. And, Berkshire will never get it in a position where it needs money. And we factor in, like I say, we factor in some things that are not ridiculously unlikely. And I'm not going to spell out scenarios because to some extent, if you start spelling out scenarios, you may increase the chance of them happening. So it's not something that we really want to talk about a lot. But our position will be to stay at Fort Knox. But we don't need we don't need a 100. It's a little higher now than it was at quarter end. We don't need 130 or 35 billion, but we need a lot of money that's always available, and that means we own nothing but treasury bills. I mean, we never buy commercial paper. We don't count on bank lines. One or two of our subsidiaries, a few of our subsidiaries have them, but we basically want to be in a position to get through anything, and we hope that doesn't happen. But you can't rule out the possibility any more than in 1929 you could rule out the possibility that you would be waiting until 1955 or the end of 1954 to get even. Anything can happen, and we want to be prepared for anything. But we also want to do big things. If the prices are attractive, as Greg said, there was a period right before the Fed acted. We were starting to get calls. They weren't attractive calls, but we were getting calls, and the companies we were getting calls from after the Fed acted, a number of them were able to get money in the public market, frankly, at terms that we wouldn't have given it to them.
All right, this next question is one that, Greg, you actually touched on the answer to this to some extent, but maybe the two of you could expand on it. It comes from Richard Surser from Tucson, Arizona. He says, Berkshire's annual report indicated that Berkshire had 391,539 employees at the end of 2019. Which areas of our operations have already been hardest hit or will be by the coronavirus pandemic, and what are the implications for the continued employment of those people?
Those people are employed in dozens and dozens of different industries, and there are a few industries that there's a fair likelihood that our employment could be reduced, but they're not large. I'm just thinking as I'm talking. I mean, it's not like we're in the some of the businesses that are, we're not in the hotel business or various aspects of travel and entertainment and all of that could really be changed in a very major way. So I don't see our employment. I'll put it this way: 5 years from now, I think Berkshire will be employing considerably more people, and I don't see where we'll have large dips. But the virus could take off in certain ways that in some of our manufacturing businesses, for example, the demand could be dramatically reduced, and in those cases we would have layoffs at some point. Greg?
What I would add, Warren, is that as we are in the sort of crux of the pandemic, we're still dealing with it, so our businesses have adjusted. Some have had to adjust more. We have, if you look at Berkshire Hathaway Energy, for example, you can see U.S. electricity consumption's down 4%. That realistically doesn't impact that business in a significant way, and longer term will continue to grow that business. So even during the crisis, a relatively small impact to the business. But as Warren knows, we do have retailers that their doors are shut right now, be it our See's Candy, some of our jewelers, and at that point in time, we do adjust and adapt to the environment, i.e. we adjust our workforce, but equally we do see for example, C's, at a point, our stores will reopen. And at that point, we reemploy the folks. And overall, for Berkshire as a whole, as Warren said, 5 years from now, we see our employment numbers being far greater than they are today, in that we see great prospects within the operating businesses as a whole.
Yeah, Seas is an interesting example because we've owned that since 1972. That's a long time, and we love it, and we continue to love it. And I have a box here of our peanut brittle, and I've got another box of fudge right here, and I'll probably take them all home and not share with Greg. But we were in the midst of our Easter season, and Easter is a big sales period for Seas, and I don't know whether we were halfway through, but we weren't halfway through in terms of the volume that's going to be delivered because it comes toward the end, and essentially we were shut down, and we remain shut down. The malls that we've got 220 or so retail stores, and we've got a lot of when Furniture Mart sells our candy, but the Furniture Mart's closed down. And so Seas business stopped. And it's a very seasonal business to start with. So we have a lot of seasonal workers, too, that come in, particularly for the Christmas season. But we have a lot of Easter candy. I mean, Easter candy's kind of specialized, too. So we won't sell it. And we produced a good bit of it. And we couldn't ship it. And we couldn't put it in stores. And there's some of that's going on. And of course, Greg does all the work on those sort of situations. And our managers are terrific, of course, in dealing with it. But this is a very, very unusual period. And like I say, a few years from now, I think Berkshire will be employing more people than 395,000. Over the years, we started with 2,000 at the textile business, and we've still got the same playbook.
This next question comes from Drew Johnson, who says that he's a longtime shareholder who's attended a couple of meetings. He says in an interview on April 17th, Charlie mentioned that some small businesses owned by Berkshire would not reopen after the pandemic eases. Can you elaborate on which businesses might be impacted?
Well, even we have businesses within businesses. At Marmon, don't we have 97 different businesses, for example?
Exactly,
yeah. Yeah, and there are some that weren't doing that well before. And I'm not talking about Marmon specifically, but they got a couple of them, and there's a couple of, and it may be that in effect what's happened in the last couple of months has accelerated the decline of those businesses, or their customers are developing different habits. I mean, people are developing different habits in retail. There's no question about that. Now, that doesn't mean we haven't got a bunch of good retail businesses, but there are businesses that were having problems before, and that have even greater problems now. We don't own our newspapers anymore, but we're financing Lee Enterprise, which does have them. We've actually increased our investment in the newspaper business by selling the papers to Lee and then refinancing their debt. And the newspaper business was having plenty of problems with both circulation and advertising before the virus came along, but advertising declines every place have accelerated fairly dramatically. And when the automobile industry stops, the auto dealers don't advertise as much. It's made certain businesses that were tough before even tougher now. And there will be management of at least one of the subsidiaries is suggested to us, and so there'll be some changes in a few businesses, but they're very small businesses. Our major businesses and our business of intermediate size, I can't think of anything that's of significance that won't reopen. But it won't be any fun with the businesses where the world has really changed. You're seeing a lot of change If you own a shopping center, you've got a bunch of tenants that don't want to pay you right now. We don't, and the supply and demand for retail space may change fairly significantly. The supply and demand for office space may change significantly. A lot of people have learned that they can work at home, or that there's other methods of conducting their business than they might have thought that from what they were doing a couple of years ago. And when change happens in the world, you adjust to it.
Yeah, I think go ahead.
Becky, I think Greg won. Yeah.
Well, I was just going to add on the Marmon example, our 97 companies there. For example, we have a food service group which sells equipment to a variety of the restaurants. We have a few businesses that realistically were challenged when the industry was performing really well. And as we come out of the crisis, their economic prospects aren't going to be better. And in fairness to the teams and the employees in there, they understand that and they're working through it, and there'll be other opportunities potentially within the company, within Marmon and things like that. But there's a very specific answer or example relative to the question.
This next question is a follow-up on that. It comes from Chris Freed of Philadelphia. And he says it's been a long-term policy of Berkshire to not sell or close any ongoing subsidiaries as long as their business prospects weren't a money hole. Over the last year, he points out the sale of Berkshire Hathaway Media, and then Charlie's comments from that interview saying that several small Berkshire subsidiaries will not be opening when the coronavirus lockdown is lifted. So should shareholders assume that Berkshire has now changed its long-term policy in regards to keeping underperforming subsidiaries around?
I think that policy was spelled out for maybe 30 years or so in an addendum in the annual report, that we have said that if a company or if an operation, we think its prospects are that it will continually lose money in the future, that we will certainly we'll try to sell it to somebody else. But one way or another, we will not continue to hold it. And that is not a new policy, and it's not been changed. You can say, in effect, we did that with the airline industry to some extent. If we owned all of an airline now, it would be a tough decision to decide whether to sustain billions of dollars in operating losses when you know, A, you don't know how long it's going to happen or occur, and secondly, you know that it's very likely that there'll be too many planes around, and we know what happens in airline pricing when load factors go down and there's an oversupply of airline seats. So, we didn't have to make that decision in terms of our own operation on it, but we did make a decision that's a very tough management decision to make. And the government, of course, they've had the first wave of financing for the airlines, but to the airlines' credit, they have very aggressively raised money. I mean, it's amazing to me what a good job they've done of that. And in the case of, I think in the case of three of them, two of them, but there may be more coming, they've raised equity money too. I mean, they are saying to the debt holders and investors, you've got to put more money into this business if we're going to be able to continue. And the government's done it, and private sources have done it, and it's exactly the right thing for the managements to be doing. But whether it makes sense, we'll find out for the investors.
This next question comes from Eric Lafont, and it's directed to Greg. He asks, how is Precision Castparts handling the severe slowdown in the aerospace industry?
So very consistent with everything we've just discussed, which is obviously a large part of their business is the aerospace industry. and it can really be broken into three areas as we do in our queue, but two are being impacted. The defense contract business remains very sound and strong within Precision Castparts, but if you look at the large body aircraft, the aircraft that they use within the regional jets, that business will move directly with the demand there and the jets that are ordered longer term. So Precision Castparts is literally, as we speak, continuing to adjust their business relative to the demand that would come out of Boeing. They would be having weekly calls with Boeing, recognizing what are the production orders there and adjusting the business accordingly.
Yeah, Boeing raised $25 billion just a day or two ago, and they raised $14 billion before that, and a year ago they felt they were in a fine cash position, and I understand how all that happened. Airbus has had the same situation. They've made some comments recently within the last week, the fact that, they really don't know what their future is. And I don't know what their future is. We're gonna have aircraft in this country. We're gonna be flying, but the real question is whether you need a lot of new planes or not, and when you're likely to need them, and it affects a lot of people, and it certainly affects Precision Castparts. It affects General Electric. It obviously affects Boeing, it is a blow to essentially have your demand dry up, and it goes up in the chain, and the aircraft manufacturers didn't bring it on themselves. The airlines didn't bring it on themselves. Precision Castparts didn't bring it on itself. General Electric didn't. It's basically that we shut off air travel in this country, and what that does to people's habits and how they behave in the future, it's just hard to evaluate. I don't know the answer, but we do know that it will have an effect on Precision Castparts, and how severe it will be, it depends on the same sort of variables that are hitting Boeing and you name the company in aircrafts, and aircraft's a big business. And this country's good at it, incidentally, too. I mean, if you think about Boeing, it is one hell of a company, and it's important. It's a huge exporter, and it affects a lot of jobs, and some of them are with us. And we hope for the best, and we wish everybody the best, obviously, and we wish ourselves the best in it. But part of it is certainly out of our control.
Right.
This next question is for Warren. Do you think GEICO will experience unusually high profitability in 2020 due to the reduced amount of driving, even after giving customers a 15% credit?
Well, we have promised to give our customers, at GEICO, we're the second largest auto insurance company, and different auto insurers are handling a sharing of the better experience with their policyholders in different ways. Our plan will deliver back $2.5 billion, roughly, or so, in recognizing the reduced frequency of accidents during this period. What we don't know is how long this will continue. I mean, people want to drive their cars still, but conditions have reduced that driving dramatically, obviously. Now, we have instituted a program that runs saving people money for 6 months, and so far, other people have largely been 2 months, but some of them have given a little more for those 2 months than we give per month. Our total is the greatest at $2.5 billion, and in addition to that, we and all the others in the industry, it's not just GEICO, we've also, and insurance commissioners in many cases, I believe, have required it, but we have, we give people more time to pay if they aren't paying, and if they cancel their policy or if they don't end up paying us, we've in effect giving them free insurance during that period. And And the delay in payments is obviously increased. Delay of payments on, if you got a shopping center getting rent, the delay in payments is what happens during a period like this. And that will be a significant cost to us. We don't know how significant it will be. There will be more uninsured motorists driving, and they cause a disproportionate amount of accidents. And so there's a lot of variables. We made our best guess as to what we're going to do to reflect the current reduced accidents in our premiums that we receive, really over the next year. It applies for a 6-month on renewals, but that we'll be renewing policies in October that will extend it then next April. And so we've made a guess on it, and we'll see how it works out.
This next question comes from Steven Stoller. He's a shareholder in Atlanta, Georgia, and he says, would you please help us understand the effects of COVID-19 on our insurance businesses? Other insurance companies have reported losses from boosting reserves for future insurance claims that they expect to be paying as a result of coronavirus. Yet in Berkshire's 10Q released this morning, we do not appear to have reported much of these future expected losses. Can you tell us why this is the case? What kind of risks Berkshire is underwriting that allows us not to be affected by the pandemic? Or conversely, what we are writing that might be?
Well, the amount of litigation that is going to be generated out of what's already happened, let alone what may happen, is going to be huge. Now, just the cost of defending litigation is a huge, enormous expense, depending on how much there is. Now, in the auto insurance field, which is our #1 field in terms of premium volume by some margin, that's more definable. But who knows what comes out of it in terms of litigation. But in what they call commercial multiple peril, which involves property losses, and where some people elect to buy business interruption coverage, many policies, quite clearly in the contract language, would not have a claim for business interruption under a commercial multiple peril policy where you've elected that. But other policies do. I think I know of one company, I don't know the details, that's written a fair amount where they cover, or certainly there's a good argument perhaps that they cover business interruption that might arise from a pandemic. Well, they're in a very different position than the standard language, which says that you recover for business interruption only if there's involves physical damage to the property. And you can buy all kinds of different policies. We are not big in the commercial multiple peril business. So I mean, this is not like our auto business or anything of the sort. But we will have claims, we'll have litigation costs, but proportionally, it's not the same with us as with some other companies which have been much heavier in writing business interruption as part of a commercial multiple peril. But you don't automatically get coverage if you have business interruption. I mean, for example, I think it would be unusual if, say, General Motors had a strike, which they did, and that they have business interruption that covers the strike. Now, we actually wrote about, probably the only annual report in the United States, we wrote about business interruption insurance because we had it over in France when one of our properties was adjacent to a property that's much smaller property that had a fire, and then it spread to our plant, and it caused a lot of physical damage, and we have business interruption that ties in with that. But if we had some company we were selling auto parts to and they had a strike, our business would be interrupted, but it's not covered by that is not part of the coverage unless you specifically really buy it. So there's There's some claims that are going to be very valid related to this, the present situation. There'll be an awful lot that there'll be litigation on that won't be valid, and there's no question that some insurance companies, I know one particular, that will pay a lot of money relative to their size in terms of policies that they've written, and I think we have reserved, and our history shows we generally have reserved on the conservative side adequately, at least, and that's certainly our intent. And we tell no managers of any of our insurance operations what numbers we expect from them or do any of that. That they evaluate their losses and they build in something for social inflation. They build in things for all kinds of things. And generally speaking, Berkshire's been pretty accurate in its reserving, and I have no reason to think that we're otherwise than that currently.
Stephen Tedder from Atlanta, who says he's a 10-year Berkshire shareholder, writes in and he says, do you see Berkshire offering pandemic coverage in future insurance policies?
Well, the answer is we insure a lot of things. Sure. I don't. We had somebody come to us the other day wanting insurance involving a $10 billion protection on something very unusual. We're not going to make that deal in all probability. In fact, I would say it's dead. But we would have written pandemic insurance if people had come to us and offered us what we thought was the right price. We would have been wrong, probably, in doing it. But we have no reluctance to quote on very unusual things and very big limits. We're famous for it. We haven't done that much of it in certain periods because the prices aren't right. But if you want to come and insure almost anything, and we don't want you to insure against fire if you happen to be a known arsonist or something. But if you come to us with any unusual coverages, either in size or in the nature of what's covered, Berkshire is a very good place to stop. And so somebody wants to buy, they can dream up the coverage and they can tell us the price they'll pay, and we'll consider writing it. We wrote a lot of business after 9/11, for example, and there were really only a couple companies in the world that were willing to write the business, and Berkshire and AIG wrote a lot of business, and we thought we knew what we were doing, but we could have been surprised. I mean, there could have been some follow-on incidents from 9/11 that we wouldn't have known about. You don't know for sure the answer. That's why people are buying insurance. But we would be willing to write pandemic coverage at the right price.
This next question is for Greg, and it comes from a shareholder named Todd Flaska. He says, I don't expect Berkshire to outperform the S&P 500 during good times. However, I remain a long-term investor because of the huge war chest that can be deployed during the downturns in the market like we're seeing right now. Warren has been brilliant at negotiating mutually favorable deals with companies that have somewhat urgent capital needs during these downtimes. These opportunities may only come about once a decade. There's a small window of time for these deals. They all come at once, and you don't really know if you're at the bottom of the market when the deals start coming. Will Berkshire be able to continue this approach when Warren and Charlie are no longer at the helm?
I fundamentally, without Warren and Charlie at the helm, I don't see the culture of Berkshire changing. I don't see our ability, which a large part of that is having the business acumen to understand the transaction, the economic prospects, and then the ability to act quickly. I really don't see that changing as we evolve. Listen, there's no one better than Warren and Charlie, but equally, we've got a talented team in Berkshire, both at the Berkshire level and within our managers that can obviously look at opportunities too very quickly. But, you know, the reality is it's a huge advantage we have right now, and we would clearly want to be in a position to maintain that position of strength. Warren?
Yeah, we will maintain it, and we not only have it with the managers of the, in some cases, not all cases by a long shot, but in some cases we have managers that will occasionally come up with something that can be quite attractive. But between Greg and Todd and Ted, we've got three extraordinarily good minds in terms of allocating capital. And you know, Charlie we may get an occasional call because of someone we knew 20 years ago or something, but they know a lot more people. They've got a lot more energy, and their minds work the same way as ours have in the past. So I think it could very well be a significant improvement when the three of them are thinking about capital allocation than when Charlie and I are now, particularly now that he's found Zoom.
All right, this next question comes from Max Rudolph in Omaha, Nebraska, and he asks if Berkshire or any of its fully owned businesses have participated in any of the bailouts from the Fed or the Treasury.
I certainly don't know of any. I guess you could say while we own the airlines, well, you know, the question's about fully owned businesses, and there's no way that I wouldn't know about anybody that did any of that. Greg?
No. In fact, we've been very clear with the businesses, but our businesses understood how Berkshire operates, and equally we're very clear that we would not be participating in any of those programs or quote bailouts.
This is a similarly related question. It comes from Seth Frieden, who says, as a long-term shareholder of Berkshire B shares, would like to know Warren's viewpoint around smaller holdings, specifically Oriental Trading Company and Nebraska Furniture Mart that are based in your hometown of Omaha. He imagines that those smaller business units have been adversely impacted by COVID shelter-in-place mandates. So would like to know if Oriental Trading or other small business units applied for PPP loans or participated in those acts. And if they didn't qualify for a loan or didn't participate, then how will Berkshire support those smaller businesses to make sure that they can continue to employ their employees?
Yeah, well, to my knowledge, none of them have gone in for government money, and the two that are mentioned, I don't like to get into specific companies, but I can assure you that the Nebraska Furniture Mart and Oriental Trading, in my view, have a fine future. But I don't want to go down the list, obviously, of every single company, because some of them I don't know the answer to. You know, we actually decided some time ago that our newspapers would have a much better chance of surviving if they were run as part of Lee than if we ran them independently. And as I said earlier, we actually put considerably more money. We probably put more money in the newspaper business than virtually anybody in the country in the last 6 months, because we took over a loan that would have been a problem in the year, whatever it might have been, maybe a year and a half. And we enabled them to just deal with one lender rather than a group. And they are doing a better job with the newspapers than we would do. And that's always our preference if we've got a business that does not have, looks like it is not going to sustain itself over time in our hands. If we can find somebody else that we think will do a better job, we'd love to have them run it. So if we have a problem business, we would prefer to find somebody that thinks they can do a better job and probably can do a better job of running it than we can. But some businesses just are superior. We We started with the textile business. We started a company called Diversified Retailing, which merged into Berkshire, became part of Berkshire, and it started with a department store in Baltimore. And department stores looked good in 1966, but the world has gone against them. And we had a trading stamp business at one time, and we stayed longer than anybody else, but the world left trading stamps behind her. And that's going to happen with some businesses. That's capitalism. And it will happen to some Berkshire businesses over the next 10 years, the next 50 years. We think we'll find more of them that will grow, and net that Berkshire will grow. But we do not think, if you own a great many businesses, that everyone is destined for success. That's why I suggest to people they buy an index fund. I do not, with the exception of Berkshire, I would not want to put all my money in any one company, although there's a few I wouldn't mind being very close to that. But I don't think, you get surprises in this world, and there will be businesses that we think are very good that turn out not to be so good, and there will be other businesses that turn out better than we think, and it's up to the world to judge our batting average over time. Greg?
Well, I would just add and echo again that when it comes to the PPP loans, we're not aware of any of our businesses taking them, and as I said, we encouraged them if they were ever thinking that there was going to be a dialogue, and we're not aware of any businesses pursuing them. I would also just add that when you look at our businesses as we went into the crisis, they responded very well. So as we look at our businesses, and Warren touched on this, our large businesses, our mid-sized businesses, and even as you go down from there, they're in very sound shape as we go through the pandemic and are really preparing to emerge now. So they're evaluating, listen, they're going to have a different customer. There's going to be different consumer behaviors, how our employees work. A lot of them work at home now. Does that make sense? And the communities we're operating in have all changed, but we're literally moving from the point of, okay, we're making it through the crisis and really planning to reemerge now. And I would say our businesses are in an extremely sound place.
We don't know when
This next question.
well, I was just going to say,
Yeah.
but we don't know. We don't know how long this period lasts, and nobody knows. We don't know whether most people think, and they know more about it than I do, that the virus will, to some extent, decline in its spread during summer months, and I would say a good many think that it will come back at some later date. And how the American public reacts if they get their hopes up through some reopening, some through some summer diminution, and how they would react to a second attack in effect by the virus. It's like Dr. Fauci, the virus is going to determine our behavior. And we're doing a lot of smart things, and we've got a lot of very smart people, but there are unknowns, and the unknowns that apply to the health aspect create unknowns in the economy, and we'll have to keep evaluating things as we go along. I hope, like crazy, obviously, that once suppressed, it doesn't come back, and that we readjust. But things don't always work perfectly. That doesn't mean there was a better course of action. I would not go around criticizing people at all for what they've done or anything of the sort. I just think you're dealing with a huge unknown, and I think that the degree to which it's disturbed the world and changed habits and endangered businesses in the last couple of months indicates that you better not be too sure of yourself about what it'll do in the next 6 months or year or whatever.
Warren, a moment ago you mentioned that you still are recommending that people invest in an S&P 500 index fund. Let me ask this question that came in from Kevin. He says, the last few weeks we've been hearing from active money managers that the day of passive investing is over. The historical safety of investing in an index fund long-term is gone. Would you please provide your thoughts on this topic, particularly in regards to an investment time span of 10 years?
Well, I can tell you I haven't changed my will, and it directs that my widow would have 90% of the funds in index funds, and I think it's better advice than people are generally getting from people that are getting paid a lot to give other advice. You don't make a lot of money advising an S&P 500 index fund. I mean, how you can say the day of index funds is over? I mean, if you say the day of investing in America is over, I would disagree quite violently. And then is there something special about index funds being a terrible way to invest? I just don't think really, it's very hard to have evidence of that. I mean, if the index funds reflect the market, and one side has high fees that think they can pick out stocks, and the other side has low fees, I know which side's going to win over time. And you have to recognize that it's in a great many people's interest to convince you that they can do something that they may well even believe they can. And a certain percentage of them will do it from luck, and a few people will do it from skill, and that's what makes it so enticing that you can find the Jim Simons or somebody that's going to produce extraordinary return. Jim and his group have done it by brain power, but it's very unusual, and incidentally, they're going to charge you a lot of money, and they're going to actually maybe close up their fund if they do it, because they can't do it with really huge amounts of money compared to how the record's been established in the past. So you just have to recognize you're dealing with an industry where it pays to be a great salesperson, and it pays even better if you're a great salesperson and you can actually produce something. But the money is in selling. There's a lot more money in selling than in managing, actually, if you look to the essence of investment management.
I got a number of variations on this next question, some more polite than others. This one's right about down the middle. But this is from Mark Blakely, who writes in from Tulsa, Oklahoma, and he says, like many, I'm a proud Berkshire Hathaway shareholder. However, in comparing the performance of Berkshire with the S&P 500 over the last 5, 10, or 15 years, I've been disappointed in Berkshire's underperformance. Even year to date, Berkshire is trailing the S&P 500 by 8%. To what would you attribute Berkshire's underperformance? Well, I can't imagine ever selling my Berkshire stock. At some point, money is money.
No, I agree with everything that I forget his name, but said. I mean, the truth is that I recommend the S&P 500 to people, and I happen to believe that Berkshire is about as sound as any single investment can be in terms of earning reasonable returns over time. But I would not want to bet my life on whether we beat the S&P 500 over the next 10 years. I think I obviously think there's a reasonable chance of doing it, and we've had periods, I don't know how many out of the 50, 55 years we've been doing it, or I don't know how many we've beaten or not. I mentioned earlier that 1954 was my best year, but I was working absolutely with peanuts, unfortunately. And I think if you work with small sums of money, I think there is some chance of a few people that really do bring something to the game. But I think it's very, very hard for anybody to identify them. And I think that when they work with large funds, it gets tougher. And it's certainly gotten tougher for us with larger funds. And I would make no promise to anybody that we will do better than the S&P 500. But what I will promise them is that I've got 99% of my money in Berkshire, and most members of my family are may not be quite that extreme, but they're close to it. And I do care about what happens to Berkshire over the long period, about as much as anybody could care about it. But caring doesn't guarantee results. It does guarantee attention. But, Greg?
Well, I would agree, Warren, that there's never guarantees, but when I look at the assets we have in place and the teams that are in place, i.e., you're committed to Berkshire, but we have dedicated teams that equally are dedicated to Berkshire, and they're sure going to give it their best effort every day. And when I look at the assets and the people, I think we have, as you said, you can't guarantee it, but we have a great chance of sure giving a good effort to outperform it.
It's hard to imagine getting a terrible result with Berkshire, but anything can happen. And what I do know is it would be easier to be running $5 million than our book net worth at Berkshire at the quarter end, I think, was 370 some billion, which is down, but it's still greater than the book net worth of any corporation in the United States. It's maybe there's some federal corporation that has more, but in terms of it may be the greatest in the world. I'm not sure. That makes life difficult in some ways too.
Right, and the potential of our operating businesses are substantial. When you think, we've talked about energy, you touched on it, that infrastructure is continuing to change. We're ready for $100 billion of investment opportunities there. If we just look at the business over the next 10 years and the infrastructure that's required and how it's changing, substantial investments there, that just tell me we have very good prospects. And we're well positioned to pursue them. Which again, to me, when you look at our core businesses, you touched on them: Burlington, the insurance, and energy. It's tough. Our downside is very nicely protected. We have three really core great businesses.
Yeah, and we're better positioned than anybody in the energy business. Just because we don't have dividend requirements, we've retained $28 billion of earnings over 20 years. That you can't do it if you run a normal public company. And we've got a huge appetite, and the country needs it. The world needs it, and we are a very, very logical, well-structured, well-managed, I would say, because it doesn't involve me, company to participate in just huge requirements around the world now. They're slow and they involve governments and state governments, and there's a lot of. It's not anything that happens dramatically. It will happen, and Berkshire should participate in a huge way. We can do things in insurance nobody else can do. That doesn't mean much many times, but occasionally it may be important. So there are some advantages to size and strength, but there are disadvantages to size too. If we find some great opportunity that for $1 billion to double our money, that's $1 billion pre-tax, and that's $790 million after tax, and on a market value of $450 billion or whatever it may be, it doesn't amount to much, unfortunately. We'll still try and do it if we can.
Yeah.
Hey, Warren, I want to ask this question that came in because I think some people may have had a misinterpretation about something you said a few minutes ago. This is the benefit of being able to get these questions real time. But a few moments ago, you were talking about the people at the company who will be allocating capital after you and Charlie are no longer doing it. And you mentioned that you've got Todd, Ted, and Greg all doing that. But I've gotten a few questions that read similar to this. This one's from Edward Papula in New York City, who says, "Dear Warren, I noticed you didn't mention Ajit Jain when you reeled off your list of future management. Is he out of the picture?"
Well, Ajit is not in the capital allocation business. He is the best. Well, he's got one of the best minds in the world. I mean, I wrote his father after he worked for us for a few years. I wrote him again the other day, but 20 years ago I wrote him and I said, if you've got another son like this, send him over from India because we'll own the world. No, Ajit is one of a kind. Anybody will tell you that's had any contact with him, and particularly anybody in the insurance business where they know him well, he is absolutely one of a kind. But his job is not capital allocation, it's evaluating insurance risks, and that is he possesses a rare talent, and he has a huge capital backing to do it. So he's an incredible asset. But Greg and Todd and Ted have been in the asset allocation business in a big way for a long time. That's their game, and Ajit's game is insurance. So that's why I mentioned those three. And incidentally, while Charlie and I are around, we kind of like capital allocation ourselves. So we're not going anyplace voluntarily, but we probably will go someplace involuntarily before that long. Charlie's in good health, incidentally. I'm in good health.
Greg, let me ask you one of these capital allocation questions. This one comes from Matt Leibel, and he says, Berkshire directed 46% of capital expenditure in 2019 to Berkshire Hathaway Energy. Can you walk us through with round numbers how you think differences in CapEx spending versus economic depreciation versus GAAP depreciation, and help explain the time frame over which we should recognize the contracted return on equity from these large investments as we are shareholders as we as shareholders are making in Berkshire Hathaway Energy?
Right. So when we look at Berkshire Hathaway Energy and their capital programs, we try to really look at it as it was highlighted, really in a couple different packages. One, what does it actually require to maintain the existing assets for the next 10, 20, 30 years? i.e., it's not incremental, it's effectively maintaining the asset, the reflection of depreciation. And our goal is always to clearly understand across our businesses, do we have businesses that require more than our depreciation or equal or less? And happy to say with the assets we have in place and how we've maintained the energy assets, we generally look at our depreciation as being more than adequate if we deploy it back into capital to maintain the asset. Now, the unique thing in the lion's share of our energy businesses that are regulated, and that exceeds 85% of them, 83% of them, we still earn on that capital we deploy back into that business. So it's not a traditional model where you're putting it in, but you're effectively putting it in to maintain your existing earnings stream. So it's not drastically different, but we do earn on that capital. But what we do spend a lot of time, and that's what, when Warren and I think about the substantial amounts of opportunities, that's incremental capital that is truly needed within new opportunities. So it's to build incremental wind, incremental transmission that services the wind or other types of renewable solar. That's all incremental to the business and drives incremental both growth in the business. It does require capital, but it does drive growth within the energy business. So there's really the two buckets. I think we would use a number a little bit lower than the depreciation. We're comfortable the business can be maintained at that level. And as we deploy amounts above that, we really do view that as, quote, incremental or growth CapEx.
Yeah, we have what 40 billion or something. What do we have in kind of in the works?
Oh yeah. So we have basically, as Warren's highlighting, 40 billion in the works of capital. That's over the next effectively 9 years, 10-year period. Approximately half of that we would view as maintaining our assets. A little more than half of it's truly incremental, those are known projects we're going to move forward with. And I would be happy to report we probably have another 30 billion that aren't far off of becoming real opportunities in that business. Now, as Warren said, that takes a lot of time, it's a lot of work. The transmission projects, for example, we're finishing in 2020. Were initiated in 2008 when we bought Pacific Corp. I remember working on that transmission plan, putting it together, thinking 6 to 8 years from now we'll have them in operation. 12 years later, and And over that period of time, we earn on that capital. We have invested, and then when it comes into service, we earn on the whole amount. So we're very pleased with the opportunity, but we plant a lot of seeds, put it that way.
Yeah, and these are not, it's not like they're super high return thing, but they're decent returns and over time. And we're almost uniquely situated to deploy the capital as opposed, I mean, you could have government entities do it too, but in terms of a private enterprise. And they take a long time. They earn decent returns. I've always said about the energy business, it's not a way to get real rich, but it's a way to stay real rich. And we will deploy a lot of money at decent returns, not super returns. And you shouldn't earn super returns on that sort of thing. I mean, it does. You are getting rights to do certain things that governmental authorities are authorizing, and they should protect consumers, but they also should protect people that put up the capital. And you know, it's worked now for 20 years, and it's got a long runway ahead.
All right, this next question comes from Jason in New Jersey. As both a Berkshire and Occidental shareholder, I was encouraged to see your investment in the company, but with passing weeks, it became evident that your investment facilitated Occidental management's ability to avoid a shareholder vote on the Anadarko acquisition, a very shareholder-unfriendly outcome. This deal proved to be irresponsible and expensive from an Oxy perspective, and ultimately very value-destructive for Oxy shareholders. In my view, it also permanently hurt Berkshire's reputation in the marketplace. Please comment on this unfortunate outcome and tell me why Oxy shareholders and other market observers shouldn't feel this way.
Well, yeah, we said right from the beginning, although we didn't certainly expect the degree to of what's happened. We said essentially when you buy into an oil, a huge oil production company, you know, how it works out is going to depend on the price of oil to a great extent. It's not going to be your geological home runs or super mistakes or anything like that. It is a investment that depends on the price of oil. And you know, when oil goes to minus $37, it's happened the other day for I guess it was the May contract. You know, that's off the chart, and if you own oil, you should only own oil if you expect these prices to go up significantly. I don't know whether they'll go up significantly or not. We're in the transaction. Our commitment was made on a Sunday when the management of Anadarko favored Chevron. And Chevron had a breakup fee of $1 billion, and Occidental people have been working on it for several years, and it was attractive at oil prices that then prevailed. And it doesn't work, obviously. It doesn't work at $20 a barrel. Certainly doesn't work at minus $37 a barrel, but it doesn't work at $20 a barrel. And everything the oil companies have been doing, whether it's Exxon or Occidental or anybody else, it doesn't work at these oil prices. That's why oil production is going to go down a lot in the next few years, because it does not pay to drill. Now, that's happened at other times in the past, but the situation is, you know, you don't know where you're going to store the incremental barrel of oil, and oil demand is down dramatically, and for a while the Russians and the Saudis were trying to outdo each other in how much oil they could produce. And when you've got too much in storage, it doesn't work its way off that very fast. Now, you will have production of oil go down in the United States significantly. It does not pay to drill in all kinds of formations that it paid before, and it doesn't pay to have paid the price that oil was trading at in the ground a year or two ago. And to that extent, if you're an Oxy shareholder, you know, or any shareholder in any oil producing company, you join me in having made a mistake so far in terms of where oil prices went, and who knows where they go in the future.
Let me follow up with this one then. This one comes in from Manish Bal, who says, is there a risk of permanent loss of capital in the oil equity investments?
Well, there certainly is. You know, there's no question. If oil stays at these prices, there's going to be a lot of money, a whole lot of money, and it'll extend to bank loans, and it'll affect the banking industry to some degree. Not it doesn't destroy them or anything, but there's a lot of money that's been invested that was not invested based on a $17 or $20 or $25 price for WTI, West Texas Intermediate oil, and but you can do the same thing in copper. You can do the same thing in some of the things we manufacture. I mean, but with commodities, it's particularly dramatic. And, you know, farmers have been getting lousy prices, but to some extent, the government subsidizes them. I'm all for it, actually. But if you're an oil producer, you take your chances on future prices, unless you want to sell a lot of futures forward. Oxy actually did sell 300,000 barrels a day of puts, in effect, that or they bought puts, and sold calls, in effect, to match it, and they were protected at $10 for a layer of $10 a barrel on 300,000 barrels a day. But you're really buying, when you buy oil, you're betting on oil prices over time and over a long time. And oil prices, there's risk. And the risk is being realized by oil producers as we speak. There will be, if these prices prevail, there will be a lot of bad loans and energy loans or bad debts in energy loans. And if there are bad debts in energy loans, you can imagine what happens to the equity holders. So yes, there's a risk.
All right, this question comes from Bob Coleman. He says, Warren, could you bring us up to date with the status of your equity put contracts? Sourcing the 2019 annual report found on page 60, it appears at 2019 year end, the fair value liability was just under $1 billion. And if the indexes declined 30%, the liability obligations ballooned to $2.7 billion. So if the indexes are down 60%, would Berkshire's obligation be close to $5.5 billion? Does that math seem reasonable? And are there any loose ends or open exposures associated with
we, between 2004, I think, and 2006, I think we wrote 48, maybe 50 contracts, something like that. The shortest was 15 years. The longest was 20 years. And we received, as I remember, roughly $4.8 billion, which we were free to do with what we wanted. And we agreed to pay based on where one or more of four indices were selling for at the time of expiration. They were so-called European-style puts, where they're only payable based on one date. And we did not have, with a small exception, we did not have to put up collateral, which was part of the deal. And we've had that $4.8 billion. We probably had an original nominal value of something over 30 billion, maybe 35 billion. That's if everything went to zero. I mean, if Dow Jones went to zero, the FTSE went to zero, and the Nikkei and so on. A number of those have run off. So we now have about 14 billion nominal. We have something less than half left. We haven't paid out anything significant. We bought back a few of them. If everything went to zero, we would owe 14 billion. If everything were to sell at the same price it was selling for on March 31st, I think the number is I think it's somewhat less than we carry as a liability on the balance sheet, which is 2 and a fraction billion. So far, so good. I mean, we've had the use of a lot of money, and the outstanding potential of them is if the market went up a lot, we wouldn't have to pay anything, and if it goes down some more, we have to pay more than a couple of billion, but we've got the liability set up for that. But so far, so good on that, and it is not anything that causes us any problem. They come due, the final one, I think, comes due sometime in 2023. I think there's, I think maybe 20 or 25% of them come due late this year, and so it's there's nothing that the questioner doesn't really understand about them. I can tell by the question, and there's no surprises there. There's no way that some liability could double up on us except based on except relating to where those indices close at the expiration of a group of different puts, which, like I say, have been more than cut in half, and we've done very well on it. Key to that.
Warren, you mentioned a few minutes ago that you...
Well, I was just going to say,
go
key
ahead.
to
Go
that
ahead, Warren.
was, with just a couple of tiny exceptions, we did not agree to put up collateral. We never would have gotten ourselves in that position. And that was, when we made the deals, we just would not get ourselves in that position, and we never will. Where on a given date, we could have some tremendous obligation that would come due that we weren't counting on having come due. I'm done then, Becky. Yeah.
Okay, thanks. So you mentioned a few minutes ago that you're very concerned about Berkshire's long-term health, too. This question came in from Drew Estes in Atlanta, Georgia, who says, there's already speculation of a post-Buffett breakup of Berkshire, and given the sway carried by modern activists, the speculation should be taken seriously. Many long-term owners see the folly in this view. A $25 billion ancillary earnings stream provides a lot of flexibility when investing insurance float. On our and your estate's behalf, could you more forcefully make the case of maintaining Berkshire's current architecture? If you don't, that responsibility will fall on an unknown set of shoulders with far less credibility.
Well, if you were to sell Berkshire's various subsidiaries, you would incur a very significant amount of tax at the corporate level before anything was distributed to the shareholders. You can spin off a given one or something of the sort, but the ability to break up a diverse company without tax implications, there was something called the General Utilities doctrine that prevailed in various ways up until 1986. And a lot of people seem to comment based on the fact that that didn't happen in 1986. And there's imaginative ways where people try to avoid taxes and can do it in some cases. On certain types of transactions, if you were to break up Berkshire, that would be one factor. But the interaction of being able to move capital around in terms of being able to do things in insurance that we couldn't do unless there were the backup earnings and capital employed in the other entities, there's enormous advantages in capital deployment within the place. So there is not a big discount to break up value embodied in Berkshire's price. And the situation actually is that although all my Berkshire shares, every share, will be given to charities pursuant to a plan I developed back 14 years ago and followed ever since, and will continue following this July. I'll be giving away $3 billion or so worth of the stock. But it involves a big voting percentage that, including other people that still remain in the picture, aside even from from the Buffett family. It isn't going to happen. Now, I will tell you, everybody in the world will come around and propose something and say it's wonderful for shareholders. And by the way, it involves huge fees. I mean, you do not get impartial advice from Wall Street when there's enormous amount of fees possible from one action and no fees applicable from another action. But you can be sure I've thought about it, and I would say that you can count on Berkshire's present posture being continued for a long time. I can't tell you what's going to happen 100 years from now, and I can't tell you exactly what would happen, for example, if certain ideas in terms of wealth taxes changed or taxes on foundations changed. I mean, but my plan has been thought out and in place for a long time, and it not only ensures that the money that's been made off Berkshire, all of it ends up going to various philanthropies staggered over time, but it also it will keep the wolves away. Greg, do you have any thoughts on that?
Well, I think the comment on the capital allocation is critical, that we have the ability to move the capital amongst be it the operating businesses or up to the insurance or down, with really no consequences to our shareholders. That's the value driver of the unique structure of Berkshire, and it creates immense value. So that's all I would add, or second, I guess.
All right, this question comes from Rob Grandish in Washington, D.C. He says, interest rates are negative in much of Europe, also in Japan. Warren has written many times that the value of Berkshire's insurance companies derive from the fact that policyholders pay up front, creating insurance float, on which Berkshire gets to earn interest. If interest rates are negative, then collecting money up front will be costly rather than profitable. If interest rates are negative, then the insurance float is no longer a benefit, but a liability. Can you please discuss how Berkshire's insurance companies would respond if interest rates became negative in the United States?
Well, if they were going to be negative for a long time, you better own equities, or you better own something other than debt. I mean, it's remarkable what's happened in the last 10 years. I've been wrong in thinking that you could really have the developments you've had without inflation taking hold. But we have 120 odd billion. Well, we have some almost very high percentage in Treasury bills, some and some just in cash. But those Treasury bills are paying us virtually nothing now. They're a terrible investment over time, but they are the one thing that when opportunity arises, it will arise at a time, and maybe the only thing you can look to pay for those opportunities is the Treasury bills you have. I mean, the rest of the world may have stopped. And we also need them to be sure that we can pay the liabilities we have in terms of policyholders over time, and we take that very seriously. So if the world turns into a world where you can issue more and more money and have negative interest rates over time, I'd have to see it to believe it, but I've seen a little bit of it. I've been surprised, so I've been wrong so far. I do not think that